Hey, gang, on today's episode, I chat with Curt Solomon, who is an SBA expert. He's been in the SBA lending space for 30 years, and we dive deep into the differences between the SBA's flagship 7A lending program and their 504 lending program. They are distinctly different, but they're both great tools and loan programs that help a small business owner acquire property, expand their business, and grow. So sit tight, tune in. It's a great conversation. You'll learn a lot. Hey, welcome listeners. Today I have the distinct honor and privilege of having Curt Solomon on the show today. Curt is an expert in the SBA space. He is a senior vice president for a business finance group. And he's had over 30 years in the SBA space. So I'm really excited about picking Curt's brain today about the two primary SBA programs that we mostly deal with, the 7A and the 504 when it comes to real estate. So Curt, welcome to the show today, man.
Thank you, Paul. Nice to be with you.
Yeah. So let's start off and give everyone a sort of a background of yourself and, your experience, kind of how you got in the space and that sort of thing.
Sure. Graduated from Skidmore College in upstate New York and wanted to stay in the area. And a 504 company called Empire State Certified Development Company hired me, which I was very grateful. And I've had a 30-year run in the industry. Spent 15 years with them. And where I found that was unique is they offered both 7A
Hmm.
and 504. So if you're asking for someone that can give you the differences, I certainly have been through that conversation many times with clients. Then back in 2008, came down to Virginia with my wife and been covering the Mid-Atlantic region for our CDC Business Finance Group since then.
Well, excellent. You picked a fine time to move in 2008,
Yeah.
just as an aside. But anyway, why don't we start off real quickly before we get into the differences and everything? And unless you think it's appropriate to hold till later, is what is a CDC? I mean, what is
Sure.
that?
Sure. So as we'll get into it today, there are two primary programs, the 7A and the 504. A 7A is basically administered through your lending institutions, your banks, your credit unions. The 504 program is specialized, and you must go through a certified development company that offers the program. And there's about 200 of us across the country, varying sizes, varying locations. But yes, if you are looking for a 504, they are administered through a CDC, and we service, underwrite, approve, and close these loans for the SBA.
Okay. Well, great. Well, let's dive right in then from the beginning. Let's start with someone who they're a business owner and they're seeking funding from time to time for different reasons, and they've heard about SBA, the good, the bad, and the ugly. I think a lot of people were introduced to SBA through the PPP program here in the last couple of years. But why don't you start with an overview of kind of the 7A and 504?
Sure. Yeah. And this is a great starting point because I think when people think of SBA, they kind of look at it as monolithic, an SBA loan. You know,
Right.
there is big difference in between SBA programs. So it's not an all catch-all item. So I would say that the two primary programs are the 7A and the 504. The 7A is what I would say is the flagship of the agency. This is administered through banks, through credit unions that offer this program. Um, Most lending institutions offer it, as I just said, but they vary in size. So you might have a community bank that does two a year.
Hmm.
You might have a specialized large bank that has hundreds of 504 loans a year. So it really varies on expertise. And that's something which I would recommend that if you were to go get a 7A loan, you might want to go do some research. The SBA has a listing of the top lenders for every geographic area. And that would be a great starting point to see, oh, they are the top 7A lender in this area. That would be someone that would be on my list.
Got it.
Um, if you're asking what the 7A program is, and I thought about this a lot last night, the best way to describe a 7A is it provides a lender a third option. If you were to go get a loan, they have two options for you. They can say, yes, we'll make the loan, or no, we can't make the loan. With an SBA guarantee, that provides that third option. We can't do this loan conventionally here, but with an SBA guarantee, we can say yes. So it's basically giving that option to say yes to you, which obviously, if you're looking for financing, that's a great answer. I kind of look at SBA 7A as, and this is important, is that the reason the bank or the lending institution can move forward is because the SBA is going to guarantee a portion of that loan. So if you borrowed $100 and you didn't pay the bank back, the SBA will replenish $75 to the lender, and that's what is attractive. It's kind of like if you've thought of PMI insurance for a home mortgage. It's just that safety net. So that's important about the 7A. And then the advantages of SBA 7A, the best thing about the program, besides getting the money, which is obviously important, is the fact that it's very flexible and has a variety of uses. You can use it for real estate, equipment, working capital, inventory needs, buying a business. So it's very flexible in the nature of that program. And one important note on the 7A is the SBA will not decline a loan based on insufficient collateral. Okay. And I think that's important. A lot of times a bank can't provide you a loan for working capital because there's no collateral. And the SBA has basically said, we will not decline someone just because it's insufficient collateral. So that's important to understand. Now, switching gears, the SBA 504 program is very specific, and that is for owner-occupied real estate and large pieces of equipment. Okay, so when you're looking for fixed assets, this is the program that I would definitely kind to focus your attention to. Unlike the 7A, where again we talked about the third option, and the mentality of that is obviously the borrower's not strong enough, maybe without an SBA guarantee. The 504 is completely different. It's for growing strong businesses that are looking to preserve capital. Okay. If you are a growing business, you need that cash to support that growth. You're hiring employees, your receivables keep on, building up. You need inventory. So you need cash to grow. And so the SBA understood this and back in the 80s created the program to allow for 90% financing. As Paul probably have told you many times, if you're looking to get conventional owner-occupied real estate and go conventional, they're going to be looking for a 20 or a 25% down payment. With the 504, because the intent is to preserve your capital, we try to limit that to 10%, which obviously that additional cash can be remained in the business to grow the business.
And Curt, I want to put an asterisk there for a minute, because the point you make about preserving capital for a growing business, and I don't know where I learned this along the way, but our general rule of thumb is growing businesses just eat cash, right? I mean, you mentioned it in terms of you're hiring new employees, you're pushing money into advertising, you're expanding your capacity, maybe your production facilities. And that's investment that comes in advance of your revenue and profit, right? You've got to be able to plow cash in this beast that's growing. Eventually you'll get your return, but at some point you got to feed the beast. And if you're putting it into your bricks and mortar, then you might not have it then to feed the beast. So you could put yourself in a position that not to win, let's just say.
Absolutely. And I have it right here. Don't put into the brick and mortar. So, but it's fascinating. Yesterday, I was making a presentation to a bunch of banks, and I brought up an article that back in the 90s, it's called Why Businesses Can Be Profit Rich But Cash Poor. And it is, I will send you the article because I think you might want to share that. It's just extremely important to understand that if you're a small business, that cash has to come from somewhere. And, right, in most cases, you make profits, and those profits, those excess cash flow is reinvested back in the business to fund that growth. Well, if you think logically, if you're buying a building and you're going to need that cash flow to support the debt service on the building, you don't have that cash that you've generally been relying on. Anyways, it's a short, if not a short, 6-page article, but love to share with you. Yeah, one other thing I just want to talk about is the advantage of the SBA 504 is this is bond financing. most businesses that are on this call today cannot just go to the bond market like GE or Apple and get their fixed rate financing. So the SBA understood that and decided that this creation of this program is to pool all these small businesses across the country each month and have one block sale. And because these are backed by the United States government, the risk to the bond holder has been reduced, which reduces the rate. So it's a below market fixed rate for 25 years. So that's another advantage that we will talk a little bit later on why it's so important to stabilize your occupancy expense. But that's important to know. And then the biggest contrast between 7A and 504 is, as I said, 7A, you go to a bank, you go to a credit union, they one shot, boom, they provide that loan to you, they service that loan. With the 504, there's three parties involved. The primary lender, your bank, credit union, they're providing 50%. We're providing 40%. That's your SBA 504 bond in a second position. And then you're responsible for that 10% down.
Got it. So would you say it's a little more of a complicated process on the 504 than the 7A?
I would say that the complication comes in the fact that you're dealing with two parties. But if you see the benefits that you would get, then obviously I'm willing to put in the effort to get more of an advantage in my structuring or my financing. So you are right. There is more complication, but again, this is what I do every day. So we know we've worked on a couple of deals together. We collaborate and we all get our marching orders and we work down and get it done.
Yeah, no doubt. I mean, I think if it's done in a team approach like we've done before, then you can the end buyer, their impact is minimized in terms of multiple parties involved, and so it can be seamless in a lot of cases. What about let's shift gears a little bit and talk about, okay, so we have these two different programs, different purposes, benefits on each, but what about eligibility and the process? What's involved there? Can just anybody get these loans?
Absolutely. So let's talk about eligibility. If you look at SBA in general, this could be 7A or it could be 504. You need to be for profit. You've got to be privately owned. You've got to be an eligible small business. And basically that's talking about you're providing some type of service. I don't want to get too technical, but for example, an apartment building, that is called passive investment real estate. It's not a small business. You're not providing a service. Right. However, a daycare is a small business. So we won't go through the list, but I think you get the gist. And then for profit, that kind of kicks out anything that's a nonprofit, anything like a church that would not be eligible for a 504. Again, the purpose of this program is to create and retain jobs. So that's the primary focal point of the program. As far as a definition of a small business, that varies based on program. So the 7A has revenue size, employee size, and it's hard for me to give you that specific data because it's based on industry. So if you're a restaurant versus a hotel, that revenue, that job could be completely different, especially for a manufacturer. I think you have to have over 500 jobs to be considered not a small business. So I'll leave that for another day. As far as the 504, it's pretty simple. Do you have a net worth less than 20 million? And do you have net profit after tax on your tax return that does not exceed 6.5 million? So based on those parameters, you can see that in my 30 years, I've maybe seen a handful of cases where I've said, sorry, you're just too big. Most of the people I deal with are small.
Right.
As far as information that would be required for any type of loan, it's pretty standardized in the industry. Your historical tax returns, your personal financial statement, your personal tax returns. I think the one thing that we're very focused on that maybe a bank or a credit union might not be so obsessed about is year-to-date financials. So if we're in the midst of 2024, we're not going to really want to rely just on your 2023 tax return, but we're going to want that company prepared balance sheet, profit and loss statement, receivable and payable agings if you have them. And that's one thing that I recommend, that if you don't have a good handle on your QuickBooks and you're looking for financing, make sure that you put in the effort and take care of that, because I've seen uh, deals where they've taken months because they'd have to get their CPA to complete a year to date because they don't have the ability to do it, which is
Yeah.
frustrating for them. But again, it's something that we would expect.
On the financials, so what are you looking for? I mean, from a qualification standpoint.
Okay, so bottom line, we're looking for the ability to repay the loan historically. So we're going to be looking, if this is a rent replacement deal, they own a restaurant, they are sick of spending money on rent to the landlord, want to buy their own place and retire in 20 years, which is a great example of using the program. We're going to look at that. What is your rent here, and what are your profits, and add backs to see if you can support the building. Now, I'm not saying that it has to be positive that you can afford it. Historically, we do are able to look at based on projections, but again, from a rule of thumb, we are looking first to see if that you can afford the building.
Are you looking for any trends in terms of like profitability and that sort of thing? Because you're looking for like typically three years back, right? Is kind of what you want to see.
Yeah, right now it's been tough because we're coming with the last cycle with COVID. There's not a lot of standardized trends, as you can imagine. Um, but yeah, we are certainly looking for trends, and that's why a lender would require 3 years, because you want to look backwards to see if there's any blips or anything that needs explaining.
Got it. Got it. Okay, so having your financial house in order, at least up to date, so you can present, is a really important step in the process. And then what else is involved in the process typically?
With respect to what?
Like I say, hey Kurt, I want to get a 504 loan, and do I have to have? I don't want to buy a building. Should I have a building already identified? Is this something that you can sort of review all my financials in advance and say, yeah, like on the residential side, a lot of times people get a pre-approval letter, right, where they'll go out.
Absolutely.
Yeah.
I got it now. Yeah. So we are here to support small business. While we cannot move forward with the SBA process until you have an executed contract, many times I get calls from borrowers, what can I afford? And we will walk through them, do a cash flow, and go, based on the cash flow, you could be looking at a $2 to $3 million building and support that building safely.
Mm-hmm.
So we'll have those conversations. And again, it's always good to have that with their bank partner too. So again, let me back up. When you're looking for a 504 loan, you're going to contact me directly. But as I said before, there's got to be a primary lender involved. So generally we'll say, who do you bank with now? Let's get a three-way call. Let's all work together. And sometimes they don't work with a bank. They have they don't have a specific lender relationship.
Mm.
And then they sometimes ask me, would you recommend someone? And certainly we would do that. But that's the first step. The process starts with an executed purchase contract when we start getting on the train tracks towards an approval and a commitment letter.
Very good. Yeah. Okay, so it's interesting to me. It's kind of funny that a lot of business owners, they've never bought a building before, for instance, and they think the process is the real estate they bought is maybe the home they live in, maybe an investment property or two, and they sort of come into the process in many cases thinking it's sort of the same process, right? I mean, you go in a contract, you're going to close in 30 days, all you need is a couple of tax returns and all that, but this process is different pretty significantly. So can you outline kind of expectations?
Yeah,
um,
yeah. Before I do, let me tell you a quick story that just happened last week. So you have a borrower. Most of the people we deal with, this is the first time buying commercial real estate. They were working with a residential realtor, and they put together a contract for a closing in 25 days. Um, and that right off the bat, there's got to be expectations, and we want to be transparent. An appraisal is going to take 25 days on a commercial property. So I would suggest that if you are looking at a real estate, look at someone that can be your back that has done commercial real estate to make sure that you have the contingencies in there so you don't lose any money in a deposit, if that
Right.
makes any sense.
Yeah. Yeah. For sure.
Um,
I see that too. I've seen that. And you in a lot I highly recommend that folks that we work with a commercial realtor that's got the proper expectation experience, because so many of the residential realtors they are driven by a very short timeline, and it's hard for them to see because they've not been through the process. And they do set expectations, and so but if you do in that situation, you have to adjust it right away. Because what is it going to take? So we get an appraisal that's 25 days, and assuming that you have your financial house in order, and you can provide, the tax returns, the year-to-date financials, the receivables and the payables, that sort of thing. What's it going to take?
yeah, and one thing I'd like to comment, the reason that it takes some time is we are your trusted advisor. You're buying a building. We want to protect you. So, getting an appraisal to make sure it's worth that. But one thing that I would highly recommend to understand is that this is not residential real estate. There could be potential environmental issues. And while it takes longer to get to a closing, we're doing all this due diligence to protect you. And I'll give you a great example. I live in the Richmond area and was working on a deal in Carytown, which is a nice area, and the borrower did not want to wait to get the proper financing in place. So he bought the building with seller financing, took title to that property. Well, guess what? 50 years ago, it was a dry cleaner.
Oh
And
no.
it has cost $25,000 to clean up the site. And I'm not going to say, I'm not an attorney. I don't know if he was responsible, but is that the kind of headache that you want on your shoulders? So yes, is it longer process than a residential closing? But most of the time, the reason it takes longer is because we're protecting you.
Hmm. Yeah. Well, that's good. And what do they say? Fools rush in. I forget the exact expression, but you definitely don't want to rush into a commitment that's going to be 1 million, 2 million, 3 million, 5 million, whatever it might be, without due diligence. And the thing about the contract, I'm with you. I've seen that too before, where deposits go hard, and most borrowers don't understand that concept of, hey, you've got a certain period of time for due diligence, and if you don't have a reason to escape the contract in that period, then you have a good chance of losing your earnest money. And it's generally more than $1,000 if you're buying $1 million building or $2 million building, right? Sellers want more than that. So it's important to have the right people and have expectations of the process.
And I'll throw
Um,
this out to you, Paul. I mean, that's what's been great about working with you is sometimes when you're dealing with a borrower, they start to get emotionally tied to the building or et cetera, and are not thinking, you know what I mean.
mm,
Uh, but having someone like you that is not emotionally tied to it
mm.
and provide guidance, say, no, this is the way we should go. So that's why it's been a pleasure working with you.
Well, I appreciate that, Kurt, and you too. You guys are great with your process and your approvals, very fast. Which um, brings me to a point, because my experience working with you has been very good, and there is sort of a stigma in the world about SBA, taking a long time and being a nightmare thing. And you mentioned that every bank in America basically can do an SBA loan, a 7A, or they can partner with a 504. But there is a difference, right, in terms of like they have different statuses, right? SBA has a preferred lending status, right, with some people, which I know you guys have, but then you have others that aren't at that level. Um, can you just discuss a little bit about the difference between working with a preferred lender versus a non-preferred lender? And just because everybody can doesn't mean that everybody really should, right? In terms of do loans that they have no experience in, because that's where you get these nightmarish kind of experiences, I think.
Yeah. And so right off the bat, I just got off the phone yesterday with someone. Yeah, I heard it takes 6 months to get approval. So how do I structure the purchase contract? So the rumor mill is crazy, but I'll try to
Yeah.
set the record straight. So with the 7A program, many of your experienced SBA 7A lenders out there are called what is called preferred lending lender program, PLP.
Mhm.
That basically allows them to approve 7A loans without having the SBA go through their process. They're pre-approved. They have their ability to make loans. So in that case, you're talking the approval process could be less than 24 hours. Not saying the whole process takes 24 hours, but I think we're just focused on SBA and that entity. So again, if they're a PLP lender, very quick. If they're not and they're doing a traditional submission, maybe a week. So but again, it really depends on, that would be a conversation that you'd want to have. As far as 504, we had a call yesterday with the SBA, and their turnaround time is 2.4 days. So it's pretty attractive. I'm not saying the whole process takes 2.4 days, because we can get into what we do initially, but by saying that SBA takes forever or SBA is a problem, if there's a problem, more than likely you're pointing the finger at me, not SBA. As I said, 2 days turnaround time.
Well, well, or you're dealing with someone on the front end that isn't either communicating clearly what they need and why, and getting the proper documentation right, or a lot of times the borrowers themselves, for whatever reason, don't get you what you need to be able to submit this package to SBA, right, or to sign off if you're a PLP lender.
That's correct. So it's generally, and I will say this, we are here to do, I'm so passionate what I do. I want to find ways and be as creative as possible. But just be mindful, most of the times delays are caused by circumstances. And when I mean that, by, if I have a situation where there's some issues, such as I have had a medical problem, and I have a credit score of 560. I had a previous bankruptcy, and I don't want to go on it forever, but you see, when you have those type of things, I will let the borrower know. You know the timeline that might be extended a little longer, because there's going to be a little more explanation. It takes a little longer to explain these issues. I'm not saying I can't get it done. We probably can get it done, but it's going to take a little longer. So I think that's where the rumor mill that it takes forever, because you're getting those isolated cases where it's a tough loan in the first place.
Right, right. Well, I think, and tell me if you agree or disagree with this. I think, when you're buying so most business owners generally don't wake up one day and say, "Oh, I'm just going to go buy a building tomorrow." Right? It's a process. Something's marinating in the back of their mind for whatever reason. Maybe your lease is coming due. You've been in a 5-year lease and you've had rent escalations, and you're thinking, okay, it's coming due in a year. Or maybe you just signed a lease renewal and you're like, I don't want to do this again in 3 years, right? And so it's a process. And so if you start thinking about this and getting involved in the process seriously, maybe 6 to 12 months before you're out there really trying to find the property and go into contract, all that, you can get all your ducks in order, right? Early. And so when you go into the process, it's a much more stress-free process than if you just kind of, throw caution to the wind and, I'm going to go get a building tomorrow and just kind of throw it all at everybody. I've seen too. I mean, some people operate like that, but probably not the best way to approach it.
Proactivity. That's the biggest thing. I got two examples just from this morning. One, someone that decided to enter into a purchase agreement without even thinking about financing. And now everyone's biting their nails because of the settlement date, and no one's got a package. No one knows what's going on.
Right.
Versus another person that I'm working with that's got a wonderful company. He's not looking to find a building for another 6 months, but wants to understand. I was talking about earlier, what can I afford when I start going searching? Here's my tax returns. Here's my financials. Do you have any questions? We're taking care of the underwriting before they even find a property.
Yeah.
That might be a little too early, but again, for him, it's going to make the most. It's going to work out at the end because he has his ducks in a row.
Yeah, yeah, and you can be more strategic about the process, and you can be more strategic about the building that you find or whatnot. And speaking of that, so talk about construction, because again, if I'm thinking 3 years out or 2 years out, and I'm like, okay, well, I'm outgrowing the space. I think I can grow, continue to grow my business, and maybe I want to customize the space because I've got clients or patients um, or maybe dog owners that are bringing their dog to my vet, and I want to give them an amazing experience. And if I build something to suit, um, Can I do that with the program? What's involved? And the secondary question is, what about the idea of building a building larger than I need and leasing out some of the space to help defer some of the costs, and then maybe create a potential opportunity for me to grow into later as I continue to grow?
So we see a lot of construction, ground up construction. So that is obviously allowed. Be mindful that in that kind of situation, there's going to be a construction loan where the lender is going to provide you advances to pay the contractor over a time period. Then once it's all completed, then we will convert it into a 504 and you have permanent financing. But definitely is something that we can do. We do it a lot. One of the great advantages of the SBA 504 and construction deals is that if you just think of a construction project, there's a lot of added cost. You've got architect fees, you got design fees, you got construction interim interest. So, for example, if you're not even in the building yet, but you're paying interest on the advances. So there's a lot of costs that all can be capitalized into the 504 loan. So you're not paying them out of pocket. So to give you a great example, I'm doing a $15 million ground up construction hotel. And I think in that deal, there's about $750,000 just for interim interest.
Yeah.
So the borrower doesn't have to make those payments. There's no cash flow coming in yet.
Right.
So that interest is being paid and capitalized into the loan, which is a great advantage to use the program. Paul, as you were talking about, this is a growth program. We want to see expansion, retain job creation. So certainly a borrower can build a little bigger than what they need today with the intent that over the next 10 years be able to expand and complete and fill out the whole building. The rules on that is that the borrower needs to occupy at least 60% of the building initially. And then over time, it is expected that they will take on more of the building. They can lease out 20% permanently. So 20% of the building can totally be permanently leased out.
Well, that's fantastic. And yeah, we have a lot of clients that do that. And the construction thing is amazing. And obviously that's a little more involved because you have plans, specs, budgets, that sort of thing. But the point you made is huge of this interest that you can build into the loan funds, because you can't do that on a conventional bank loan, right? I mean, you're paying that freight every single month, right? As you take
Can
draws.
I comment on that really quickly, Paul?
Yeah.
So the reason that you can't probably do it conventionally is there's a different mindset. With conventional lenders, they have a targeted loan to value. We will do loan to value of 80%. Well, that interim interest doesn't add any value to the
Right.
property, so you're going to have a loan to value issue. The reason we don't have that issue is SBA gives us about a 10% variance or flexibility on the appraisal. So to help you understand, let's say we did $1 million building and it only appraised at $900,000. You would think we have a problem. However, under the SBA, that appraisal would be good for us because we want to include those soft costs. We want to include that interest. We want to preserve cash. So that's the only reason.
Wow, that is huge. Does that apply to the 7A and 504 or just the 504, that variance?
I would imagine it's been over 15 years since I did specifically 7A.
Hmm.
But yes, there should be no problem with rolling those costs in as well. Because again, under the 7A program, you're really not hitting an LTV target. As I said before, SBA will not decline a loan based on insufficient collateral.
Right, right. Now, speaking of the collateral, the question that I get a lot, and I know there's a difference here between 7A and 504. Let's say I want to go buy a building, Kurt, for my HVAC company, and I'm putting 10% down. Are you going to put a lien on my house because my wife is not really excited about that?
That is a wonderful question, and I'm glad we get to talk about it. So there is one stipulation in the SBA standard operating procedure, we call it the SOP, that basically says that if the loan is under collateralized, the lender must take all available collateral. So in many cases on a 7A loan, there would be something tied to a residence or other collateral if you have equity. So yes, very important to understand if you have equity in your house and you're asking for 90% financing under the 7A, which would be under collateralized, they're going to tie up your house. With that said, the 504 program, we do not take personal real estate as collateral. That's not our standard practice. However, would we take a credit enhancement, take someone's house, or take some additional collateral if it is a startup operation where payment is based on projection? We've been known to do that occasionally. So I didn't want to say absolute, we wouldn't do it. But I could tell you with the 7A that all available collateral, it kind of forces the lender's hand on that.
Got it. Yeah, I know it's a big point for some people, and particularly for those of us that are married. That you got to know, and so that's another point too. That just kind of winding down, just issues that I've seen. How important is it if you have someone looking to buy a building, and we've already discussed the fact that most of our folks, the people going to buy using SBA, have never bought commercial real estate before. How important is it if they are married to be like sort of on the same sheet of music with their spouse about this? I mean, because if they're not, I mean, what could happen?
Sure. Yeah. So one thing I would say is it's funny because I deal with all the banks, all the credit unions in Virginia, and there's some that would require the spouse's guarantee and some that won't, even despite the fact that maybe he or she, the spouse, does not have any ownership in the business. I find that
Hmm.
kind of interesting, but I guess it comes down to looking at their personal cash flow. You've all this debt. What is the supported income? And maybe the spouse works outside of it. But anyways, I'm going on a rampage. Let's get to the topic. With the SBA, if a spouse has no ownership in the operating company, they would not be required to guarantee.
Hmm.
However, however, the SBA is going to want a joint personal financial statement with the joint assets, joint liabilities, and both their signatures. And the reason is if, like, for example, my wife was married to Jeff Bezos and she wanted to get an SBA loan, she would not qualify because of the household income. And so that's the only reason why there's a requirement to have both husband and wife on the personal financial statement. But we don't run personal credit on the spouse; they're not involved. But that's very clear because I've had times where I'm not having my wife sign this because she's not involved, and I'm like,
Right.
I understand. It's just, does she have a $50 million trust fund? That's all we care about.
Yeah, no, it's you have to really explain that so they understand what's going on because it doesn't make sense if why does my wife have to sign this?
Absolutely.
You get a lot of pushback from business owners because they're so independent, right? And they're used to calling the shots and making decisions and being in charge. And you're like, no, it's got to happen. Um, One last question that comes to mind, and then I'm sort of want to wind down with any other thoughts that you have that we haven't covered. You mentioned credit, not checking the spouse's credit. So how important is credit to 504 or 7A loans? I mean, what do you guys look at?
Yeah, and I think that's one of the advantages of us or SBA in general is, you go to a bank and they probably have a minimum credit score that they're looking for. And if you fall under that credit score, something they can't do. We're a little different is tell me the story.
Hmm.
Give me the story. Does it make sense? And so when everyone asks me, what's your minimum credit score? There is none. It's more about what's the story if there is an issue with your credit score.
Right, right. And that's fine, but I'm sure you're still looking for some trending, right, analysis, like someone who's like had serious financial issues and they've just not really paid their bills at all. You're like, yeah, we're not going to touch that. But if someone had a life event or what, I mean, everyone has events, right? Life happens, but then a recovery from that, and we say, okay, yeah, they had this issue 4 years ago, but now since then their life has been back on track. Maybe they had a hospitalization or something, and
Absolutely. And that's what I was talking about, where unlike maybe a large lender that is looking at just a credit score, we're
yeah,
not going to just look at credit score. We want to hear the story. And that's true. There are life events that happen.
yeah,
In
yeah.
fact, I had one guy yesterday, which was funny. He had a Lowe's credit card and he never used it. Never used it. However, there was a annual
Annual
fee
fee.
he wasn't aware about. So he's got like 12 months and it killed his credit score. But once I heard this story, I'm like, that could have happened to me. That could
Yeah.
have been
Well, the guy but he saved 10% on that one purchase, right?
exactly.
I mean,
Exactly.
it's, yeah, I laugh every time they ask. Every time I go to the store, we're like, no, 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 no. And I've seen it. I've seen people do things like that. And it's like, man, it's so easy just to fall into that trap and not even know it, and the pain and the price you pay. But all right, well, good news. So you guys are common sense approach. So generally speaking, the approach with the SBA is, hey, we want to help businesses grow, and on this 504, if you're a growing business, we want to preserve your capital. We want to hear the story. We want to try to make this thing work any way we can. If it makes sense, we're going to protect you as the borrower first. We're not going to let you get into something that's going to, blow up in your face. But at the same time, we also want you to continue to thrive as a business and grow. And so instead of taking all your cash reserves and your working capital and plowing it into the building, you're going to have it for growing your business.
Yeah. Yeah.
What do we miss, Curt? What last points, thoughts?
I would say, if in summary, do your homework. Get multiple options. Talk to many people. And the reason I say that is it's human nature. As a lender, we're going to do what's in our best interest. And I love the story about, I'm a runner. If I go to a running store and that owner of that running store gets higher margins on Nike, and I come in there and say, what shoe should I get? I tell you it's going to be Nike.
Yeah.
So what I suggest is that you get perspective and just don't use one isolated, and you'll find out that you'll get the best structure for you. And I know we're running out of time, but that's what I would suggest is make sure, talk to a couple lenders and see what's the best interest for you.
Yeah, absolutely. I'm a firm believer in that. I think borrowers should be educated. The old adage is, if the only tool I have in my toolbox is a hammer, every problem is a nail, right? And so that's not good. And when you're going into this space where the dollars are big and the consequences are big, you need to be well educated on the options. And in some cases, the 7A may be your solution. It could be a 504 and maybe a conventional. It just depends on your specific goals and situations, what you're trying to do. So, well, Curt, this has been great, very educational, very interesting. I love the stories and the day-to-day experiences. I appreciate you being on. If somebody needs to get in contact with you directly, what's the best way to do that?
Sure. 540-846-7355.
Excellent. All right, we'll get that in the show notes. Curt, thanks for being on the show today, man. This is
Thanks,
great. A
Paul.
lot of fun.
Appreciate it. You have a good day.
You too. Hey, gang, just winding down here today. Thanks for listening to the show. And as always, if you need capital to grow your business, you're looking to purchase commercial real estate, or build a building, or invest in commercial real estate, or you're looking to acquire a business or a competitor, or just need growth capital, we'd love to talk to you. We fund businesses all day long. Our mission is to help entrepreneurs win and to fund their businesses and fund their dreams so that they can make an impact in their community. Reach out to me today. Go to our website, click the button to schedule a 20-minute conversation, discovery call. We'll have a quick conversation, see if there's a need, see if there's a fit, and we can take it from there. The website is VPC, Victor Paul Charlie .capital. That's VPC.capital. All right, there's no .com on that. It's VPC.capital. As always, keep crushing it and hope to see you soon around here. Take care.